Hello, everyone. Good morning and evening, everyone. Welcome to our webinar on how currency volatility impacts the agriculture industry. We have a very diverse group here today at various time zones across the world. We are very extremely excited to have you join us today. Please take note that the presentation slides will be available in the follow-up email. Welcome. For the most optimal viewing experience, please click on Layout at the top of your WebEx meeting window and enable side-by-side mode to view both presentations and our speakers during the event. Please use the chat feature at the bottom of your window, and the Tridge team member will assist you. We have real-time translation and transcription in English, Spanish, French, and German. Select Show Closed Captions and then select Translation options for closed captions and choose the language that you want to be speech to be translated. If you need any technical assistance, please use the chat feature at the bottom of your window and the Tridge team member will assist you as soon as possible. Regarding the agenda for the day, we will cover currency volatility, and the main section will be for the Rene's presentation and the other section will be for the panel discussions. Before we start, I would like to introduce Tridge. Tridge is a leading global sourcing and market intelligence platform. As an intelligence and source provider, we deliver the most timely and valid information and analysis in the agriculture industry, as we have a global network of experts actively engaging in the industry. Our intelligence includes daily analysis on the price, regulation, production, seasonality, and various other data that our clients need to understand the market and improve their decision-making skills. You can visit our website for more information. In this presentation today, we will cover how are exchange rates determined, what is the importance of exchange rates in agriculture, most recent cases, and finally, the panel discussion. For this webinar, we will be providing the certificate of attendance for those who requested after taking the survey. The link will be provided at the end of the webinar. The invitation that begins next week will include information regarding the certificate. Please take note the certificates will be available to those who take the survey. During the webinar, if you have any questions regarding the presentation or the panelist questions, please feel free to reach out on chat. We will be answering as soon as possible. Also, I must ask you to turn down your mics during the presentation and the panel discussion. I will be your host for today's presentation. My name is Bojan Mijatovic. I'm a global market analyst at Tridge, in charge for fruits and vegetables. Meet your presenter, Rene Salinas from Mexico. He's a global market analyst in charge for the meat department. He will be your presenter today. Of course, our panelists, Mevis from Nigeria, Mehmet from Turkey, and Fer for France will give more insight to the volatility questions in the panel discussions. Before we move on to the Rene, I must ask you again to turn your mics down, and please feel free to reach out in the chat department. Rene, the stage is set. You can proceed with your presentation.
Thank you, Bojan. Thank you, everyone. Hello, as Bojan said, I'm Rene Salinas, a global market analyst here at Tridge. I'm very happy to see you all here. I'm part of the global content production team specializing in the meat and seafood sectors. I'm in charge of analyzing what's happening in those markets. As for my professional background, I'm an economist, which hopefully will come in handy to explain this topic in detail. So let's get started. So how are exchange rates determined? The fundamentals behind exchange rates are typically these economic variables, which are interest rates, inflation, income levels, trade balances, and of course, expectations about any of these variables I just mentioned. It's notoriously hard to predict what's going to happen with exchange rates, as these variables are typically at play at the same time. One variable influence another, this variable influence in turn another. So this play makes the overall effect to forecast exchange rates very hard. However, since they do have considerable importance in agricultural trade flows, it's worth knowing what's the particular effect of these variables in each product, in exchange rates. Go ahead. So first of all, let's remember that exchange rates are a price of the currency in terms of another. And as all products, there's a demand and a supply for such currency. Demand and supply will move until there's a tacit agreement between suppliers and buyers. When that agreement is reached, we talk about an equilibrium quantity and an equilibrium price. Now, as you can see in the graph here, demand is downward sloping because typically buyers will want to purchase more if the prices decrease, while supply is upward sloping because suppliers will want to sell more if the prices increase. Now, let's see what happens with demand and supply when a country changes its interest rates. To illustrate, let's look at this example, which is the British pound market for US buyers. So what happens if the US were to rise its interest rates and nothing else changes? Well, US demand for British pounds would decrease because it makes more sense to go where your money will earn more interest, which would be the US. But the inverse effect happens to the UK sellers, which they are now more willing to sell their pounds for dollars. So we have two effects: a decrease in demand, which is represented by a shift of the demand curve to the left, and an increase in supply, which is represented by a shift of the supply curve to the right. What happens to the equilibrium price? Well, as you can see here in the graph, it decreases. So if we represent the exchange rate by GBP/USD, which means a single British pound can buy how much dollars, it will actually decrease. The British purchasing power in terms of US dollar decreases. We then say the US dollar appreciated and the British pound depreciated. And it's worth to note that sometimes governments can decide to lower interest rates to weaken their currency and make their exports more competitive. Next slide, please. Now, what happens with inflation? Let's consider the same market, US buyers of British pounds. Let's assume the inflation rate in the US increases more than that of the UK. In this case, demand for British pounds will increase because US buyers would want to buy goods where it is relatively cheaper. But at the same time, UK sellers would be willing to sell less pounds as they have better purchasing power now. So the overall effect would be an increase in the price of the British pound in terms of US dollars. So the British pound appreciates and the US dollar depreciates. Next, let's talk about relative income levels. Consider the same market. Let's say income in the US increases relative to the UK income for any reason. We would expect to see an increase in demand for British pounds as the purchasing power of US buyers increased. So they will want to buy more products because they now have more capacity to buy in the US and elsewhere. And we would see no changes in supply for the pound. The overall effect would be an increase in the price of the British pound as it's now more demanding. And finally, let's talk about expectations. Remember, there's different expectations for any of the variables we mentioned at first that can influence exchange rates. Let's see what happens in another market. This is a market for European buyers of US dollar. Let's say there's an expectation of a deeper recession in Europe than in the US. Now, since there's an underlying expectation the US dollar will retain its value more, the demand for the US dollar would increase. So in this case, the US dollar appreciated and the euro depreciated. Okay. Hopefully that part illustrated well what are the effects of economic variables in exchange rates. As we saw, expectations and interest rates are some of the most relevant now, which are actually strengthening the US dollar a lot against most currencies. But let's see how these variables affect exchange rates. Now let's see how exchange rates actually affect agriculture. Okay, previous slide, please. Okay, so a huge part of agriculture is traded globally, and economic theory says that some countries are better off specializing in some products and trading with other countries, and that's what typically the case. It's been like that most of the times. So in order to trade internationally, we need to trade in several currencies. When exchange rates move or fluctuate, the real price agreed between buyers and sellers is influenced, which in turn changes production planning and trade flows. Exchange rate movements could determine if I'm better exporting to A country instead of B country. Now, of course, this applies for both end products and also agricultural inputs. Now, in agricultural trade, sometimes sellers price always in US dollars, and sometimes they price in their local currency. Either way, exchange rate movements influence the real price at their bottom line. Now let's see cases when agri products are priced in dollars and when they are priced in local currency. So we're going to see the overall effect of exchange rate movements. Next slide, please. So let's see this first case. Okay, prices in US dollars, exporters' currency appreciates against the US dollar and the importers' currency depreciates against the US dollar. Okay, so in this first case, in January 1st, for 1 ton of beef, Europeans paid around 4,400 euros and Brazilians received around 27,900 Brazilian reals. Brazil is the exporter and Europeans are the buyers. Okay. Now, let's assume here in the slides you can see the price, which is $5 per kilo. So they could buy they needed that currency to buy that amount, that 1 ton of beef in January. Okay. Now, assume Europeans are willing to pay it. Previous slide, please. Okay. Assume Europeans are willing to pay the same amount in euros as in January. For the same amount of euros, they will be able to purchase only 0.9 tons instead of 1 ton. So we would expect to see a decline in demand. Okay. Meanwhile, let's assume Brazilians want to receive the same deal as in January. However, if prices remain the same in terms of US dollar, the amount in reals they would get will be only 25,700 Brazilian reals. So they will be willing to sell only 0.9 tons instead of the previous 1 ton. So we would expect to see a decline in supply as well, which would raise prices in the USD. And as you can see, the overall effect is the depreciation of the euro and the appreciation of the real would pressure price. The fall in demand would pressure prices down, but the decline in supply would pressure prices up. The overall effect would be a slightly decrease in prices, but the main effect would be less trade from these 2 countries, as you can see here in the graph. Okay, next slide, please. So in this second case, we're talking about we're still talking about prices in US dollars, but now the exporter's currency depreciates as well as against the US dollar, and the importer's currency depreciates against the US dollar, which is a typical case with what's happening now. So let's say the equilibrium export price of beef in Australia was in January $5 per kilo. These were the exchange rates in January, but in September you can see both currencies fell. Both currencies, the Australian dollar and the Chinese currency, also fell as well. Okay, so both currencies depreciated. So in January, for 1 ton of beef, Chinese paid around 31,786 yuans, and the Australians received 6,800 Australian dollars. If we assume that the Chinese are willing to pay the same amount in yuans as in January, they will be able to purchase only 0.9 tons with this new exchange rate instead of 1 ton. So we would expect to see a decline in demand. Okay. But meanwhile, let's assume Australians want to receive the same deal as in January as well. With prices remaining the same in terms of US dollars, the amount in Australian dollars they would get would be more. It would be 7,258 Australian dollars instead of the previous one, which was less. So now they would be willing to sell more instead of the previous 1 ton. We expect to see this in the graph as an increase in supply, which would actually lower prices in US dollar. As we can see in the graph, the overall effect would be a falling price, an important falling price, but trade flow remains the same. A quantity trade remains the same, but the price actually decreases in terms of US dollars. Next case, please. Okay, so now let's talk when sellers price their products in their local currency. So in this case, we're seeing importers' currency depreciates against local currency. The scenario is this: beef in Australia is priced in Australian dollars, and Japanese buyers are looking to source beef from Australia. The equilibrium price in Australia was 6.9 per kilo. Okay, so in January 1st, to purchase 1 ton of beef, Japanese buyers paid 575,000 Japanese yen. Okay, but in September, to do the same, they will have to pay 690,000 Japanese yen. Or assuming they're willing to pay the same Japanese yen as in January, they will only purchase 0.8 tons. So we would expect to see a decline in demand. Supply, as is determined in Australian dollars, would remain the same. Okay, so the overall effect would be to drive equilibrium prices in Australian dollars down as well. Now, this is a very interesting graph because some might think that a stronger dollar is actually bad for food prices. Nonetheless, the stronger US dollar has caused an increase in supply. I'm talking about an increase in exports, as we saw the cases before, and a mildly lower demand, mostly imports outside of the US. So these two effects combined create lower prices, and you can see it here in the graph. Overall, food prices have started declining in the same line as the US dollar strengthened. Let's see, the right axis here in this graph is inverse. So with a stronger US dollar, we are seeing a fall in food prices overall. Of course, this might be just short term, but this is the effect that's happening right now. Okay. Now, for this next part, we will explore some of the recent cases where exchange rates have influenced prices and some trade flows, as well as the outlook for some currencies and the threats and opportunities exchange rates fluctuations can have in the global agri market. Okay. So first, let's look at the euro. Okay. As you can see in this graph, the euro has depreciated 11% against the US dollar so far this year. High energy prices, fear of recession, and of course, faster hikes in the US interest rates have all contributed to the euro's weakness. This weakness is expected to remain in place for the upcoming months. A weaker euro should boost internal trade, European countries trading with European countries. But outside of Europe, there could be an increasing demand for European products as their exports are now cheaper for importers, relatively cheaper for importers. However, imports of inputs and other products are now relatively more expensive for European buyers. Please go ahead. Okay. A recent case is the European trade with Vietnam. Recently, there were reports that Vietnamese sellers were experiencing difficulties with seafood orders from Europe. European buyers are changing or even canceling their orders, so overall imported volume has decreased. As a result, Vietnamese sellers have been pressured to lower their prices. Okay, so both currencies have depreciated against the US dollar, but the euro has depreciated against the Vietnamese currency. So in this case, we would see a decline in overall traded volume from Europe, European importers from Vietnamese exporters. Now let's talk about the Japanese yen. This currency has been one of the worst hit against the US dollar. It has weakened as a result of an increasing divergence between interest rates in the US and Japan. Japan is not planning to raise interest rates, and there's expectations for this gap to widen. For now, weakness is expected to remain until Q1 2023. So imports into Japan should become more expensive. Okay. Now, this one is an interesting graph. So if you chart the Japanese yen and the Norwegian krone against imports for fish fillets, for example, Japanese imports from Norway, there may seem initially that there's no clear relationship. But if we chart imports against the exchange rates 5 months before, the relationship seems clear. So as the Japanese yen weakens against the Norwegian currency, making imports more expensive for Japanese buyers, import volume for the future, or contracted volume now for the next 5 months, decreases. And so for this product in particular, we could use the exchange rate as a leading indicator as to actual imports 5 months into the future. Exchange rates could tell us where imports going to be 5 months to the future. Okay. Now let's talk about the Australian dollar. Year to date, it has depreciated 5% against the US dollar, driven by expectations of slower interest rate hikes compared to the US. However, the Aussie's depreciation has been notably lower compared to other major traders, which we just saw, such as Japan and Europe. So expectations are that the Australian dollar could begin recovering by Q2 2023. Now let's look at the second graph, the second chart below. The general trend of Australian beef and veal exports has been clearly in line with the inverse of the Australian dollar and US dollar exchange rate. So as the Australian dollar weakens, exports tends to increase. There's a very clear relationship with beef exports and the Australian dollar US dollar exchange rate. With a weaker Aussie, we get higher in exports. Okay, let's go to Canada now. The Canadian dollar has depreciated 3% against the US dollar year to date. US interest rates and expectations of more to come have been the main drivers of a weaker Canadian dollar. Nonetheless, as in the case of Australia, its depreciation has been relatively mild. Now let's travel to India. So the rupee has depreciated 6% against the US dollar to touch fresh lows in September. The aforementioned hikes in US interest rates, a fear of a global recession, adding to the fact that India is a large oil importer, have been behind the rupee's weakness. However, the year-to-date depreciation rate, as in the case we saw before, has been relatively slower compared to other countries as a result of relatively better economic fundamentals. But nonetheless, most forecasters are still expecting further weakness for the rupee in the months to come. Let's look now at the Turkish lira, which has also been one of the worst hit currencies. We're now looking at its purchasing power against the euro. Okay, so it has depreciated 90% against the euro. Okay, touching record lows in September. So interest rate cuts. This country is actually cutting interest rates instead of the trend, which is to raise interest rates to combat inflation. So these interest rate cuts amid worsening inflation and a widening commercial deficit are behind the lira's sharp depreciation. Nonetheless, as we saw in the examples before, this weak lira is very supportive of exports. In fact, Turkish agricultural exports during the first 8 months of 2022 were reported increasing by 20% year over year. So now let's dive into the currencies which have fared better against the US dollar. Okay, let's talk about the Brazilian real. Year to date, this currency has appreciated 9.5% against the US dollar. High interest rates in Brazil, which are around 13.5%, and good economic fundamentals, despite ongoing uncertainty over upcoming presidential elections, have driven the real to be one of the currencies which has strengthened the most against the US dollar, and most other currencies as well. However, the real strength has lowered the attractiveness of exporting some products, such as coffee, and you can see this effect in increasing global prices in US dollar terms, okay? Now let's travel north to Mexico, where the peso has appreciated 3% against the US dollar as well. High interest rates, around 8.5%, keeping up with US interest rate hikes. The Mexican Central Bank has responded to US hikes as well. And other fundamentals such as fiscal discipline, better economic indicators than originally expected have been behind the peso strength. So the expectations are for the rate to remain stable around 20 pesos per dollar. Finally, let's look at the Russian ruble, which has been the best faring currency against the US dollar this year. As you can see in the graph, there was a major weakening in late February, early March as a result of the Russian conflict with Ukraine. However, the ruble recovered and strengthened well beyond pre-conflict levels afterward. So, what's behind this strength? Hiking interest rates and surging energy prices, of which Russia is a main exporter, are behind the ruble strength. However, this is expected to begin fading as it's now been seen to hurt Russian exports income in terms of rubles. So Russia's government is slashing interest rates in order to hamper this ruble strength and make their exports more competitive. So let's look at how the ruble strength has affected the global agri-market. A stronger ruble has partially driven Russian wheat exports in July and August to fall 27% year over year to multi-year lows. And this decline comes at a time when production is actually reported to be at a record high. So this decline is further more notable with this other data. So with these lower exports, there's lower global supply, which in turn drives prices higher. And we can see this with London wheat futures prices, a weaker ruble. You can see how the ruble strengthening correlates well with London wheat futures prices. The ruble strength is compared to the British pound. And so, of course, a weaker ruble would in turn support exports, which in turn would help to ease these current global wheat prices. Finally, let's talk about this graph, which is the summary opportunities and threats of what's happening here. So these currencies in the first column are all compared to the US dollar, and here's the year-to-date percentage change. We first place the currencies that have appreciated against the US dollar, and then the ones that have depreciated in that order. Okay. So talking about the Russian ruble, with a stronger currency, the opportunity, of course, is, well, they have a stronger import capacity. And we can see the cases where, for example, India is trying to boost exports to Russia with settlements in rupees. We have heard that Ecuadorian banana exports are soaring right now. So this reflects this larger capacity for imports in Russia. What's the other side of the coin, the threats? They have a weaker export capacity. So they have not enough incentives to export record high grain production, as we just spoke about, or inputs such as fertilizer. And lower supply causes higher global prices. To talk about the Brazilian real, the stronger currency leads it to have a stronger import capacity. So with a stronger real, Brazilian producers get cheaper input products, relatively cheaper, such as fertilizer. Okay. But they also have a weaker export capacity. So they may have less incentives to export coffee and other products, resulting in higher global prices. Now let's talk about the peso, which has appreciated against the US dollar, but more mildly than the other currencies I just mentioned. So with a stronger peso, as the case in Brazil, Mexican producers get access to cheaper input products such as fertilizer. Both Brazil and Mexico import fertilizer. But they also have weaker export capacity. So Mexico perhaps has slightly less incentives to export fruits and vegetables than before. And now passing into the currencies that have weakened against the US dollar, well, there's a stronger export capacity in India for Indian rupees. So the same case as in Russia, India is trying to boost its exports to Russia with settlements in rupees. Okay. But they also have a weaker import capacity. And as we mentioned before, India is a major input importer. It imports a lot. It's a large oil importer. So this reflects on higher domestic prices and so higher input costs such as fertilizer and energy. Okay. Now let's talk about China. The Chinese yuan has depreciated 9.3% against the US dollar so far this year, which means there's a stronger export capacity So there's more incentives to export soybeans, assuming enough domestic supply, which is typically the case. So with this global supply increase, global prices ease, okay? But the other side of the coin, which is a weaker import capacity, so these less imports of several products, they have since China is so large, where there's an important effect in global demand. So if we see a decline in global demand, we would see weaker global prices. Now let's talk about the euro, okay, which has depreciated 11 to 12% this year. So this stronger export capacity, a result of its weaker currency, you can see, for example, grains and other products should become more cheaper to import from outside. And as global supply increases, global prices could ease. But there's also a weaker import capacity. So with higher domestic prices, high input costs such as fertilizer and energy, which has been the case, it has been in the news all over the place, this is reflected here. Okay. Now let's talk about the Japanese yen, which has depreciated almost 20% year over year. No, sorry, not year over year, year to date. So there's this stronger export capacity. For example, seafood exports are expected to increase in Japan, but there's also a weaker import capacity. So we see, as in the cases in Europe, there's higher domestic prices, higher input costs, such as fertilizer and energy as well. And finally, we have of this selection of currencies we made, the worst hit currency, which was the Turkish lira, which has depreciated 27% against the US dollar. So this weak lira has actually incentivized exports. Turkish agricultural exports have soared in January, August, increasing by 20% year over year. But they also have a weaker import capacity. So they are facing higher domestic prices, higher input costs, such as animal feed. And I'm finished with my presentation. Hopefully this was illustrating and we could see the overall effects of exchange rates in agriculture. Thank you.
Thank you for your overview of recent cases and outlook on the global agriculture currency volatility. I really like the summary slide with opportunities and recent cases in the outlook for the global markets. Now we will move forward to the panel discussions. Once again, I ask you, if you have any questions regarding the webinar and the topic, please feel free to post it on the chat option. Now we will move on to the panel discussion. As I mentioned before, our panelists are Mevis from Nigeria, Mehmet from Turkey, and Fer from France. We will try to touch on some important questions regarding the currency volatility topic and use their on-the-field experience. For the first questions, how do buyer-seller behavior change during periods of fluctuating exchange rates in respective markets? We will ask Mevis from Nigeria to introduce herself and please answer for the first question. Mevis, you have the stage.
Hi, afternoon. Thank you so much. My name is Mevis Aiyeju. I'm Senior Global Fulfillment Manager in Nigeria, and I'm specializing in export, and I've been doing this for about 6 years from Nigeria right now, focusing on our cash crop raw exports of cashew, sesame, ginger, hibiscus, right? Yeah. So regarding the question, I mean, I thought it was an interesting one. And I think the presentation from Rene obviously also speaks to some of these elements. I think if I look at how the behavior changed, both from the buyer and seller perspective, I would say first off, from the seller's perspective, they immediately take advantage, and especially, and I think this is not just Nigeria and many African countries, once the currency weakens, the local currency weakens, they use this to artificially just hike up prices of the raw material, right? And way beyond the actual change in the exchange rate, right? So if there was a 2%, 3%, 5% change in the exchange rate, they would increase the price by 10%, right? And if you're asking why, they would say, well, because of the exchange rate, which of course, I mean, you know, it's never really sustainable. So they usually start with that, right? So there's always that like knee-jerk reaction, where they just hike up the prices artificially. And at times, obviously it's not sustainable, because at times their prices are now hiked up so much that, you know, the ex-works price is higher than the CFR price globally, right? So there's no way to sustain that. And obviously, I have to say, in a country like Nigeria, we have two exchange rates, right? So we have the Central Bank of Nigeria's exchange rate, right? And then we have the parallel market exchange rate. And obviously, they would always use the parallel market exchange rate to determine their prices of the products. So that's on the seller end. And, you know, it's always a bit challenging in the first few weeks. And I think a lot of people who are smart are probably, once these spikes happen, we kind of wait first before we start buying products again for the price to stabilize. On the buyer end, this is a bit more interesting. And I think the opportunities that Rene spoke about apply to big companies, right? So exporters. When I mean buyers, I mean local exporters, sorry. What they do is, because in many countries and in Nigeria, there's a lot of incentives for export, right? Especially raw material export. And there's also restriction to access to Forex, right? And access to USD because of the weakness of the Naira. And what happens when the Naira drops so drastically, a lot of these big companies then actually choose to export agro-commodities to be able to get Forex, right? And a lot of times, these are actually companies that were not in agro trading before. This is not even their business, but they have the capacity, they have the cash flow, they have the money. So, and unfortunately, what that does, it does then bring up the price of the actual product within the market, right? Because they're not so much interested in margins, but just more in the Forex, right? And then you have processors and co who then suffer, right? Because they can't match the prices of these major companies who are just pretty much doing it for the incentives and the Forex. And the incentives, I mean, the strange thing is that the incentives do take quite a while to actually come in. So it's not like the government provides these immediately, but for companies who have the financial capacity, they would do this. And even if it means they're getting their incentives in a year or 6 months to a year or so, right? But then it's often substantial and it's in Forex. So yeah, that would be my response, how buyers, sellers kind of react to currency fluctuation in Nigeria.
Mevis, it was very useful. We are moving on to France. Sir, please, can you introduce yourself and share your views of this question?
Of course. My name is Fernando Dupuis. I'm Chilean, born and raised in Chile. I moved to Europe 13 years ago. Everybody called me Fer. That's why here they call me Fer as well. So I was working already on the food business for 16 years, and mostly purchasing for importers based in France and into the Netherlands. So answering to this question and how is their behavior, for example, in terms of the exchange rate and fluctuations, etc. Well, their finance department, what they do is monitoring every day, almost every day, how the rate conversion is. So in order to buy dollars, because all transactions that we're doing, for example, with the exporters is mostly in dollars, except with some based in South Africa or in Africa that they will and are willing to work in euros. But yeah, my experience is also with the South American countries, and they are willing to work mostly in US. So in that respect, yeah, the importers need to check every day if it's convenient or not to buy dollars, if it's convenient to buy dollars at that time. Talking about March this year, they bought a lot, and then they will checking also the daily price. So at the end of the day, they are deciding to pay based on the daily currency or what they have already on the bank account. So it's actually, at the end of the day, the fruit trading is also currency trading, at least in Europe. It's very funny to experience that and I'm sharing this with you. But what happened afterwards, after the invasion of Ukraine, after the war there, and the most biggest impact was when Russia cut definitely the gas to Europe, is the fact that and as you can see, the euro went down the hill, and most of the importers decide to pay in advance. Normally, the transactions with the exporters is I pay you the remaining part of the cargo 30 days upon arrival. Now they decide to pay as soon as possible because they were already forecasting a decrease on the or bad ratio between the euro and the USD. The people who wait until the 30 days, they lost a lot of money because all of the sudden their cargo was much more expensive than initially intended. So that's part of the answer I can give on to this question. And the other part is how the buyers are reacting. They don't care. That's the most important part here in Europe, at least. The biggest buyers are retailers, and the retailers are fixing the prices in euros. So for them, any kind of fluctuation is they're not concerned about that. They just want their product on the price agreed at the beginning of the season on the currency used in Europe, which is the euro.
Thank you for that realistic approach. Mehmet, moving on to Turkey, please, can you introduce yourself and answer the first question?
Yeah, of course. Yeah, this is Mehmet Unluyurt. I've been working in pastas and grain sector for 6 years, and I'm global and trade and development manager in Tridge. So I'll try to answer those questions for you. Actually, in Turkey, the cases are quite complicated because when you just summarize the Turkey exchange rates, Turkey has been affected by the changes in the foreign rates in past 2 years a lot because it's not just like a year. When you just go back to 2020, Turkish lira was just 5.5 against the dollar. But in 2021, it was like depreciated 54% and it became like 8.5. And today is 18.3. So it depreciated like 115%. And when you just look the previous 2 years, today Turkish lira devaluated like 330% within just 2 years. Of course, there are so many indicators like pandemic, current wars, energy crisis, and everything. So yeah, these rapid and irregular changes in the dollar exchange rate have created a volatile environment for the buyers and sellers. Although Turkey is a producer country in many product groups, but there is not enough production for the to cover the domestic consumption. And also like Turkey exports a lot, and it's also like importer country. When we consider this, for the local market, the situation causes a high inflation rate, and for the many products, for the people, purchase power is getting worse and worse. So, but thanks to its geographical location of the Turkey, like which provides significant quantities of the supply for Europe and Middle East, mostly carries out the transit trade. So the companies bring the products to Turkey when the new harvest periods and re-export them after processing, cleaning, or in the same when the market has the favorable conditions. So considering that, the company buys in dollars, sells in dollars, and the effect of exchange rate fluctuation is, of course, like way lower than the selling domestic market. And also, like considering the inevitable connection between the demand and supply, exchange rate fluctuation have directly affected to reduce the purchasing power. How? Because like people are now looking for the alternative products. So it was like there were some products that top consumed, but now people are changing those. Of course, like especially like my sector is pasta and grains, which is like main consumption products. It's not such easy to ship the products to another. But for example, Mexican chickpeas, like 12 chickpeas is well consumed. It was well consumed in Turkey and it was very demanding. But lately, local market demanding more the smaller caliber chickpeas. Why? Because it's way cheaper. And also like the same scenario was for the rice and for many types of products as well. Like people, when they cannot exactly afford the meat, they're going through for the like pulses, and also they are choosing the like the demand is changing according to like where it is and the origins and all. So actually in Turkey, this reaction is happening day by day, and it's changing, like the consumption is changing so fast. But also for the Europe or the Middle East, like demand is changing for the countries. So buyer and seller behavior in Turkey, like totally changing very, very, very quickly.
Moving on to the second question, and I must ask participants of the webinar to turn the mics down so we can hear the panelists clearly. For the second question, are there any preference changes to products due to the price changes? This one, for you, Fer, please, can you answer the second question?
Yes. Okay. So actually, yes. There's a preference now, and in Europe will be, for example, how cheaper is better. That's a reality. I will put a simple case in this respect. For example, let's say that now all the products, import products, especially from South America, are 25% more expensive than the beginning of the year. I will put this clear example, and you will understand why I'm saying that. 20 September of 21, the Euro USD exchange was 117. Okay, and let's say the case of one X country from South America exporting has avocado to Europe. At that time, they asked, for example, $9 FOB with a sea freight of $6,000, all included. That gives you €8.70 per box CIF Rotterdam. However, if you do the same exercise today, the final price, including the increase of the logistic costs, etc., is giving you a CIF price for the same product, same origin, same size, same packaging, etc., of €10.90 CIF. So what most of the European importers are doing is they're reviewing again their programs, the import program. Maybe they're going to cut lines. They're going to, and that's what I heard, they want to wait until, for example, for the avocados, until the Mediterranean production starts. They're going to bring just the necessary to fulfill the programs with the supermarkets, and they are going to privilege the countries that are willing to work also in euros, and from a logistical point of view, also is cheaper to bring the products into Europe. So that's more or less the impact that we are going to have and see in Europe in that respect. So yeah, it's very challenging, and let's see how the market will react on an empty market, because this is what more of the importers are predicting. The market will be empty from South America.
We will go back now to Mehmet and afterwards on Mevis. Mehmet, please, can you follow up on the second question?
Of course. Actually, I will try to just answer this question also with the examples of the pulses, because I mean, pulse and grains are the core products all over the world, so people wouldn't stop consuming. And of course, the preferred change happens, but not to other products, shifting between varieties, as I mentioned before. But when we want to understand all the disposition, why it happens, especially in Turkey, because when we check the official data from the government, energy cost increased by 230% compared to 2021. And also fertilizers, soil improvers increased 230%. Plant production products, pesticide increased around 100%. And when you look to total agricultural input cost increased by 135% compared to 2001. So all these increases directly affect the producers as well as the consumers. If we have, if we give a product-based example, the price announced by the Turkish Grain Board, it was 3,500 in 2020, but this year they announced 15,000. And this is just for lentils, whole lentils, and it's not even the processed. So when you look at this product, now the Canadian products, Turkey used to, but actually Turkey imports a lot from Canada. And also now the local price is high, and it's making it difficult also to import the goods when you just look at these prices. And also it's not giving you favorable conditions for the export as well, because you cannot exactly compete with Canada right now as well, because the price is going to be 860 just for the whole, but from Canada you can buy it from way cheaper. So this poses a big problem when you also consider the local purchasing power and also the global market. And also same examples were for rice as well. For rice, Baldo type rice, it was before 5,000 levels, but this year it's also announced 15,000 Turkish liras. And also this is just for paddy. When it's final product is 27,000 Turkish liras per ton. But when you consider this product to also export, you cannot export, because you cannot import as well, because there is a tax 45% of this. So it's not even such enough for the local market, but also you cannot export. So what people are now doing is just like going for the cheaper varieties, such as like Luna type, which was like 4,000 previous year, but this year is almost 13,000 Turkish liras. And when you compare the other origin, still you cannot compete well. And the final price of this is like 23,000 Turkish liras per ton. So it's not giving exactly the competition too. And new regulations is required from the government because like you have to cover the local demands. But when you see the like these scales like from 4,000 to 13,000, from 5,000 to 15,000, everything changed, and now people are willing to go for different varieties such as like Chinese type of rice, which we call like groski, or medium grains like Luna, Ronaldo, this kind of products. And it's changing. Market is very dynamic in that case, and it's changing according to like how government actually act. And also we shouldn't forget that because due to pandemic, like countries stocked a lot of products. So when we see that the import rate is a bit low this year, it wouldn't give exactly the correct reason as well, because people like companies imported a lot to just stock to secure for themselves for the food safety. But at the end, there wasn't such consumption as imagined. And also there are so many stocks as well. So this year, these data wouldn't guide us well. What I want to say about this.
Well, this was very useful. Mavis, how's it in Nigeria?
Yeah, so funny enough, Nigeria, and I think the same applies for many sub-Saharan African countries, we're not as, there's no change in demand simply because the focus is more on raw material exports, and those are obviously seasonal, right? So because, you know, a lot of the African countries are don't yet have their infrastructure developed as far to be able to process and have value-added products, right? All your exports is seasonal, has a seasonal dependency. And again, due to a lack of a lot of infrastructure, a lot of, you know, traders don't store goods very well, right? So there's not proper warehousing with, you know, proper ventilation, etc. So a lot of people would not even, in fact, nobody would actually, any experienced buyer in China, India, or Vietnam for raw cashew or sesame, whatever, will likely not buy outside of season very much. Maybe sesame a little bit, but definitely not cashew, just because the quality drops and all that. So it's more of a seasonal dependency. So the only thing that happens at that time is then, okay, fine, they can either hike up the price or the price drops, but it's not like there's one or other product that will be preferred based on the exchange rate. And that just applies for any country that is doing raw material export, right? I think if you have countries that are doing processing, then there's now that flexibility to, you know, take a position and things like that. But yeah, it's raw materials, and yeah, it's all seasonal dependent. So there's no way it affects or changes what crop there's demand for or interest.
I wish everyone to notice that we will be a little bit over the time, but we were moving, and of course the slide, the presentation, and the recording of the webinar will be available at your emails via 3 business days. So we are moving on to the third and final question for our panelists. For what are measures to protect financial risks? Mehmet, you will be the first one for the question number 3.
All right. Actually, yeah, the situation is a bit also complicated for those because they tried so many things for 2 years. I will just choose like few of measures, not to take so long time, because like we have tried many regulatory measures to protect like ourselves from the impact of the exchange rate fluctuations. Of course, like there are always parties who are in difficult situation as a result of these regulations. While some regulations aim to protect the end consumer, they may bring serious difficulties to importer. And also like exporter companies may be faced with difficulties due to privileges provided to importer companies. But when you just look like in order to prevent the depreciation of Turkish lira, Turkey has banned companies based in Turkey to invoice in each other in dollars. So this causes very serious problem as well at the same time. Like it's helping to save the Turkish lira's value, but also like it's very serious problem because when the importers exchange rate managed by their bank, it can change even a minute when they invoice to another company's bank sees different rate. So for example, like $10,000 you sell to someone and they want to pay $10,000, but one is seeing like the current rate 18, another is seeing like 17.80. So who will compensate this? It's just becoming like huge conflict. And then like now Turkish companies, they're facing really big issues because they don't want to keep their money as Turkish lira as well, because it's always devaluing. So what they do, they are just making transactions and just taking back, like converting to dollar back to just be able to compete international market. And also like another regulation is that for the exporter companies, if you export, you have to convert 40% of the income revenue in which you get from in foreign currency into the Turkish lira. And this lira rate determined by the central bank. Likewise, after this process, many companies convert back to dollar at the market rate. And of course, like it may incur losses here as well as like due to difference in the central bank and the market rates. And also like apart from all this, like another situation that company is facing when the company buys a goods and stock in its warehouses, as I mentioned like before as well, like Turkey is just buying from Canada and after like spreading from all the Europe and the Middle East thanks to location. And when they buy at $10,000, stock it, and after if they sell again to $10,000, but if currency increased and it seems like now their total value is higher, government is taking tax from them, and it's up to 20%. So what it affects, of course, like this makes a serious difficult for the small scale companies to take part in international trade. And also like in products that mandatory import, they're supporting, like for example, for the chickpeas, for the lentils, like we don't have import tax. And also like we had like good harvest this year, and we can also, it's enough for our local consumption and also like some quantities for the export. But Turkey has great position to export. So what they're doing now, we are stocking a lot those products, processing and sending. But about rice is totally against, like 45%, as I mentioned before. So what it's like all the measurements is just taken suddenly, sharply, and it's not exactly predictable. And when we sum up, like there are many measures taken in the face of the high domestic inflation rate and to just secure the Turkish liras and to make exporting easier. Turkey has still great potential as buyer and seller for the core products because people won't stop consuming, as I say, like from beginning. And also like thanks to our location, like we will keep supplying all over the world, many kind of the agri products, especially for the Europe and Middle East. And I hope that everything will be better, and also like with the privileges that provided for the agriculture sectors, everything will be way stronger.
I see that Mevis is responding to the chat question, so we will move with Fer. Fer, can you answer this question and after for Mevis?
Yes, no problem. I will do it keep it short. So in Europe, actually, the situation in respect of the currency and the parity euro US dollar, it's not. It's not. How can I put it this way? The Central Bank of Europe is not worried about it. They think and they believe that the market will regulate itself if the European continent remains competitive in terms of production and is not falling into recession. Said that, what they're doing is to help and assist, for example, the consumer, the end consumer. How? Helping them to pay the electric bill because now it's too expensive, helping the growers, the internal growers. I mean, in the Benelux area, for example, the Benelux governments, Benelux is Belgium, Netherlands, and Luxembourg, are going to help the growers that are exposed to high prices of energy, for example, of the greenhouses. So they're doing tomatoes, they're doing aubergines, they're doing a lot of products that are going to be sold in wintertime. And that's the critical point, as much as they said, winter is going to be the moment of the truth. Let's put it that way. So, and said that, and in that respect, the European Union is not willing to interfere or intervene into the currency market. The only thing they're doing is to helping the consumer and also to keep the industry moving in order to be competitive and not fall into a recession. So that's more or less the situation here.
Mevis, we started with you and we are ending with you. you have the honor to answer the final question. Please. Okay, maybe.
Great, I'm honored. Yeah, it's similar to what. Can you hear me?
Yeah.
Okay, all right.
Okay.
Yes. No, I mean, the currency has actually been a huge issue in Nigeria for the past 2-3 years, but the last year has been really, really rough. And the government is just, killing, fire extinguishing everywhere, right? So there are a lot of policies in place to restrict access to forex, right? To prevent the naira from crashing further. So obviously, on one end, there's a lot of incentives for exporters, right? Which is what I had already mentioned earlier. There's a lot of incentives for you to export on multiple levels from multiple government agencies. I mean, it really is a lot. You could make more of a margin. Big companies actually make more of a margin on the incentives than the actual margin on the export product itself, right? Which is significant. And they're really trying to do that just to get Nigeria to export more and import less. However, I think there's some ways export regulations are also a little bit difficult for traders. So sometimes I feel like there could be more done to make it easier. It's a little bit restrictive. We have something similar. I think it was Fair who was talking about, Mehmet, I think, was talking about that, where the proceeds that come back, right, go into a specific account and you can't actually access it in USD, right? So there's a lot of regulations on how it has to be changed into Naira and then you can access it and all that. So, and like he said, right, and we have, a parallel market exchange rate, so you can't buy the dollar back, well, you could, but you would make a significant loss, and you can't buy that dollar back at the central bank. So on one hand, there's incentives to export, but it's still very, very difficult for you to be able to access the forex itself. Whether I think this is to prevent and to de-risk, I don't really think so. I think they're trying, but I think it's not really working. On the other hand, I understand they're trying to do what they're trying to do, but it's not great at the moment in Nigeria at all. I've seen the exchange rate in the past 4 years double, which is crazy. So so I mean, they're trying. There are regulations. There are a lot of incentives for export. There's a lot of incentives to support export because we're just not exporting enough. There are tax breaks and waivers and all those things in place for that. But I'm not sure whether it's having the effect on the business owners, right? Individual, like I don't really think it's having the desired effect on the business owners itself.
Thank you, Mevis. Thank you, Fair. Thank you, Mehmet. The presentation slides will be shared in the follow-up email. Available now in the survey on the webinar. Please participate in the survey now. Your feedback is very valuable to us. We look forward to hearing from you. On behalf of Tridge and our presenters, Rene and the panelists, myself, thank you for joining us today and have a wonderful day.